Good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall. Happy holidays. We're a day away from Thanksgiving. Markets will be closed tomorrow. We've got a half-day trading session on Friday, so it's going to be mostly a four-day weekend for a good majority of the traders out there. So let's jump into it. As you can see, bottom left-hand corner of your screen, S&P futures are moving lower. It's been a bit of a volatile past week of trading. We'll take a look at the charts in just a minute. I'm running solo this morning. The trading analysis team, we gave them the morning off. We've got many of them have family over enjoying the Thanksgiving holiday. So we're going to do things a little bit differently. I'm going to take you straight into the charts. We're going to let's start it off looking at the indexes, and then we'll transition into gold. We'll take a look at some crude oil. We'll take a look at yields. We'll also review the move higher in the dollar. So let's jump into it. If you have any specific charts or sectors you want to take a look at, I'll do my best to cover them. We're going to run a little bit of a shorter show this morning, probably finish 10-15 minutes until market close. So let's jump into it. We'll get into the Motive Wave platform, and we'll talk about what's happening in the markets. All right, good morning once again. Let's jump into it. I think we're just going to go ahead and let's go full screen charts this morning. Let's do it a little different. We'll grab our desktop capture. We'll take you full screen. We'll even get rid of that market open timer to clear things up. Okay, starting it out with the S&P 500. Let's go ahead and zoom in on the upper right-hand corner of this daily charts time frame. Zooming in into the upper right-hand corner of the screen, we can see, and we're going to go ahead and get off the daily chart. We'll take you off of the daily. We'll go to a 195-minute half-day time frame. A lot of traders always question the 195. Instead of using the 4-hour, 240-minute time frame, we feel the 195-minute chart being an exact half-day trading session is appropriate, and we find it to be very useful. Yeah, you're welcome, Lee. Absolutely. Happy to be here. Okay, so let's hit it. We've seen kind of an interesting dynamic occur in the markets since we met last. And when we met last, we had identified a wave one high going into about the November 16th high. And what that essentially accounted for was a 5-wave rally from our November 10th low. Looking at the S&P 500, the move from the November 10th low into the November 22nd high when markets rallied on news of Jerome Powell's renomination, we saw about a 2.5% rally here for the S&P 500. The NASDAQ 100 saw about a 5% move in that same time frame. So the trend is significantly more mature in the NASDAQ, and of course, as a result, the S&P technology sector, the XLK wave count. So here we can see from the November 10th low into the November 22nd high, a 5.4% move for the NASDAQ. So looking at the NASDAQ, we do have evidence to suggest that a 5-wave rally from our October 4th low has run its course. Arriving at that same conclusion in the S&P 500 is a little bit more difficult to do. In fact, you really can't count a truly completed motive trend between November 10th and November 22nd. So where does that leave us? Does that leave our orange wave 5, which is green wave 5 in the NASDAQ, does this leave orange wave 5 open for the potential continuation to upside channel resistance? For now, we feel there is a possibility that this uptrend remains intact before we see that larger corrective retracement, which we feel would then retrace the entirety of the rally from the October 4th low. Maybe a 38%, maybe a 50% rally, or 50% retracement rather. So let's get off the 195-minute half-day chart and let's focus in on price action from the November 10th low and discuss the substructure. 195 down to the 1 hour, down to the 15-minute. When we met last, we had identified an area of resistance near 47.14 1/4 in the S&P 500. And essentially what this was from the November 10th low is just a standard 5-wave rally. We have wave 3 meeting its 1618 fib projection, which, by the way, you'll notice, hey, good morning, Grady. I'll give you a buzz after the show. So you can see here, we have in our Motive Wave edition of, or the trading analysis edition of Motive Wave, our fib levels are color coordinated. We've got the Thanksgiving Black Friday sale going on. If you're interested in picking up Motive Wave, we can talk about that later. But beautiful third wave respect of the 1618 projection of 1. Wave 4 did exceed equality to wave 2, but ultimately met about a 50% retracement. And then wave 5 ended up being equal to 61% of waves 1 and 3. So essentially, if you were to measure the entire magnitude of this rally, project it from there. So that's what we looked at last Wednesday. And we were expecting this to at least give us a corrective retracement. And that it did. You'll notice the initial move down into the November 18th low retraced right at 50% of the rally. So that was appropriate. But what occurred from there is a sharp move up in a sideways consolidation, and then a secondary rally to the upside. I want you to note the resistance that came into play up here on the 22nd. We're going to look at a retracement of the entire November 5th through November 10th decline. We all know that a break above the 786 retracement often opens the door to the external 1272 retracement. That level came in at 47.4262. The actual high here was 47.4383. From that high, which, by the way, we had a gap up on news of Jerome Powell's renomination, a sizable intraday rally. That intraday rally was faded on the same session. We then rally back, same session, retraced 786, and then we've now proceeded lower. The move to the downside here, and this is the count that says, hey, look, we could maintain this uptrend and keep it alive into the first week of December. If this is the case, from November 16th, where we identified that wave 5 of 1 completion, we have 3 down of A, 3 up of B, and 5 down of C. The 1272 external retracement of the B wave rally was exactly where we met support yesterday and started to bounce. Now, I'll admit the time relationship between 4 and 2 is a bit disproportional. We are on a 15-minute time frame, so we have to consider that. The fourth wave was a 38% retracement, and wave 5 was 61% of 1 and 3. So yesterday's bounce occurred into a zone, a significant zone of fib support. We had a confluence from 3 degrees of Elliott trend. We had our orange 5 versus 1 and 3. We had our C versus B external retracement, and we had our overall retracement of our November 10th up through the November 16th rally. Now, in light of the idea that this fourth wave is a bit shallow or in short in terms of time compared to 2, there's still the possibility that this is wave 4 and we get another probe back to the lows. Looking at the S&P here on the 1-hour chart, what happens if we start to break south of this zone and we go to revisit the November 10th low? Can we break the November 10th low and still maintain the uptrend? We can. We absolutely can. The reason I don't care for this count is because this count would suggest that our November 5th through November 10th decline was just A of wave 4. The 3-wave move back, instead of this being 1 and a 2, this is A, B, and C. This would then suggest that C of wave 4 could take us down to maybe 4,600, and then we go. I don't care for this count, only given the time discrepancy in 4 compared to 2. The idea that arriving at this conclusion in the NASDAQ is a little bit more difficult to do so. It's not wrong, but I'll show you over here that it doesn't quite fit the guideline of the right look. So where do we go from here, and what are the best course? What's the best course of action? Well, as mentioned, if we start to break lower and break south of the November 10th low, then we need to look to see this be 1, 2, 3, 4. We get wave 5, and from there, a break south of the November 10th low would need to be met quite promptly with a mode of response, be it mode of diagonal or mode of impulsive. If we move to a new low and break up to a new high and then are met with 3 waves down, then I would suggest that we continue to see 3, 4, and 5 up to channel resistance before this larger wave 2 sets in. The other possibility is that the low is in from yesterday and we just continue to rally. But what happens if we break to the November 10th low a bit more aggressively and we don't stop at 4,600 fib support as we see here in this wave 4 flat? If this occurs, then I have no choice but to view the correction as now being of the higher degree wave 2 position, meaning from October 4th, we completed 5 waves up. We're just going to have to allow for the unusual wave 5 subdivision and then look at this as an ABC retracement. Even if we get this larger ABC retracement, we would view it as a viable entry opportunity. Now, if you watch my public market updates, you'll know that I do have an alternate, which would say instead of going into wave 2, we end up in a wave 4 back to the October 4th low. I don't think we're there yet. Looking at the rotations, I just don't think we're quite there yet. And even if that proves to be the case for some reason, that would still put the markets up year to date, into the October 4th lows, north of 12% in the NASDAQ, or I think it was north of 14% in the NASDAQ. So that's our game plan. That's our game plan moving forward in the markets. Let's take a look at the Russell 2000. The Russell 2000 small caps kind of recently joined the party, breaking out of a sideways consolidation that's been in existence since essentially February of this year. We have a wave count that suggests we are breaking higher in that wave 5 with the markets. We continue higher into end of Q1 next year, and then we see a retracement of this entire 5-wave structure. Now, given the overlap and given the multiple possibilities that exist in the Russell 2000, I'm almost wondering if instead of doing this, and it's still technically valid until we break south of 2293.35, I'm almost wondering if wave 5 here in the Russell 2000 is just unfolding as an expanding variety diagonal. 3 is longer than 1. 4 would need a little bit more room to the downside to be larger than 2, and that would still suggest continuation into the new year. So the Russell 2000 count is a little bit tricky. I still feel right now our best guide is going to be right here in the S&P, in that if we hold yesterday's low and rally, which it doesn't look like we're going to do, then the low's in. If we break to 4,600 and we're met with a motive impulsive response that retraces maybe half of this C wave decline, then I would confidently position for upside continuation. But if we just start to move aggressively lower, then we really have to look to this ABC. And if we're going to go ABC lower in the S&P and ABC lower in the NASDAQ, then looking at the Russell in the diagonal pattern, we could just kind of chop and slop here in a sideways consolidation. So I don't know. The Russell 2000 is a little bit tricky. The S&P Midcap 400 chart, MDY, has a very similar structure to it. Let's take a look at the MDY. The MDY here looks like we could just be in 4. We go up in 5. Then we get wave 2. A bit of a wave 2 correction, and then we see that continuation into next year. Okay, yeah. For now, unless we start to see my alternate end of year scenario unfold, which pairing that up with the Russell is a little bit difficult. So for now, I would remain optimistic unless you break those invalidation levels. Okay, let's take a look at 10-year yields. That's another chart. Alex typically covers bonds. I want to take a look at 10-year yields together. Looking at the 10-year yield wave count, and if you happen to catch my public market update, this is one of the dynamics that I'm watching here. rising rates doesn't automatically equate to distribution and growth, okay? We all know that. It has to do, at the end of the day, with why you're seeing that move in the bond market. So for now, while we do see likely continuation, gosh, let me adjust scale here, my apologies. While we do see likely continuation back to the March and April 1.75% high, probably move up to like 1.8%, we see this as likely being short-lived. And perhaps this move higher in yields is exactly what's going to set us up for that wave 2 continuation in the S&P and the NASDAQ. That's not out of the question, because this would suggest 5 waves up, and then we correct in 3 waves. That 3-wave corrective retracement in yields could be the upside continuation into Q1 of next year for equities. So daily chart here, we continue to view the directional 3-wave retracement into the November 10th low as just that, counter trend corrective move. You'll notice it has a very solid structure, down in A, 3 back in B, 5 waves down in C. Wave C ultimately exhibited equality to wave A. In addition, it also exhibited a typical characteristic of a C wave in that you have a decreasing angle of descent or ascent, depending on where you're seeing that correction. The time that we traded under equality was very brief. We then move up in 1, down in 2, up in 3, down in 4. You might think, what on earth happened here? Well, Veterans Day happened and the bond market was closed, and as a result, yields were not moving. And guess what? 5 up, 3 down to 50%, another measured move decline, and yields are pushing higher. So this is something we're going to continue to watch. It's a very important dynamic that we currently see at work in the markets. Let's take a look at some sectors here. Materials, the XLB materials sector, after concluding a 3-wave retracement May into October, has printed a 5-wave rally. This looks to be retracing in a wave 2 position. Communications continues to look under pressure. Communications, at the very least, we feel will move down to 76.5. If we break 76.5, you could move south to 73. Looking at industrials, here in industrials, we can see a completed 5-wave rally from the September area low. We don't have Terry Long with us this morning, but looking at materials on the weekly rotations, we're just moving into the improving quadrant. So if we do see continuation here, this could be a sector along with materials to explore some additional opportunities. Technology, okay, here's another chart that just says, hey, look, 5 waves from that October 4th low is in. We have a very mature trend in orange wave 5. So just like the NASDAQ, very mature trend. Just like, you know, here in the XLK, very mature trend. SMH, an industry group within technology, very mature trend. The S&P, not quite meeting the required subdivision yet, could ultimately prove to be a trap, and maybe we already are in that wave 2. Looking at healthcare. Healthcare is a name that's seen a decent recovery. Here in healthcare, either this is in fact wave 4, and we're going to move higher in wave 5, or we just simply had truncation of the higher degree corrective trend, meaning the higher degree corrective trend concluded October 13th instead of the 6th. This is just 5 up, and we're now in the ABC move lower. Okay, so that concludes indexes and sectors. Now I want to take a look at gold, crude oil, and the US dollar movement. I will get those charts. The other requests that I didn't get a chance to cover, we'll get those charts out in a public update. I'm going to be doing a public update tomorrow on Thanksgiving, taking you through some sectors and industry groups. Okay, so let's hit it up first. Let's talk about the price action in gold. If you caught my recent public market update, and here, let's go full screen on the charts again. You guys don't need to see my ugly mug this morning. Looking here at the chart of gold, when the move up occurred on that that very hot CPI report that we got, it started as soon as the report came out, an hour before the market opened. Gold futures rallied. We moved up into resistance, and we've already moved back south of 1800. So if you caught my update basically said, hey, look, we feel this is a bit premature, and we feel the corrective pattern has yet to conclude, meaning it was likely a fake out. And we continue to feel that's the case. You'll notice here from November of 2015, and that's where I'm sourcing this base channel. Technically, we could have drawn this through the 16 low, but I'm going to go ahead and draw this through the 2018 low. So from that low through that low, projected from this high, resistance, resistance. We've broken through that, and now we're back testing and consolidating. Contracting price action, higher lows, lower highs, typical Elliott Wave triangulation. Now, for all you Elliottians in the group, you might be looking at this and thinking, gosh, that's a short wave 2, and why don't you call this a wave 2 flat? That's fine. That's fine. The implications of that are very similar. The positive relationship that you have here between 4 and 2 when moving it over to a flat is your time relationship. But regardless, very similar fib zones, not too concerned. So as it stands now, you'll notice resistance, resistance, back testing the base channel, support, support. Let's get off the weekly, down to the daily. Looking at this on the daily, we feel D of triangle 4 concluded, and we now are in a 5-wave decline to be A of wave E. A move back in B could open up some downside put butterfly opportunities in GLD, or there's some other ways you can look to trade that. We're going to be looking for this to conclude out into next year. This fits the idea that I do think we have a market correction end of Q1, maybe mid Q2 of next year that would be of a larger degree trend. But based on our higher degree levels now, we might not even revisit current price action. So again, not using that as a reason to sidestep or stay sidelined in cash. So for now, downside support, major downside support is going to occur at the alternating E versus C, 61.8% relationship. Said otherwise, if you were to measure the magnitude of C, project it from D, look for the 618, there you go. We have the power of motive wave to kind of automate this for us. At the press of a keystroke, you can bring those fib levels in and out. And you'll notice as we move the fib levels, it's automatically adjusting, or excuse me, as we move our Elliott Wave anchor points, it's automatically adjusting our fib levels, so we don't have to go manually manipulate anything. And it really does save us a lot of time. So that's gold. Let's take a look at the US dollar. So here in the dollar, yeah, definitely. I figured, you know, we could switch it up, go full screen during our segments here. Looking at the dollar, and Alex did an amazing job at tracking the 5-wave decline that occurred from the March 2020 high. From that March 2020 high, 5 waves down, concluding in May with a truncated 5th wave. Truncation simply means we did not exceed the wave 3 low. From there, we count 5 waves up into July, a 3-wave flat into September. And we had one count here that, let's see, we'll go down to the 195. We have a count here that says from September, we do 1 and 2, 5 up and 3. This count was looking good for a while. The 200% 3V1 came into play. Then we get this bigger 4th wave. We were about a week off of calling that 4th wave low. Look at the magnitude of the breakout that has followed. Does this look like it's a 5th wave move? Absolutely not. Additionally, when looking at this and considering, as I like to say, the totality of the circumstances, you have a very disproportional 4v2 time relationship now followed by a huge rally that exceeds the angle of ascent in the 3rd wave. That's not characteristic of a 5th wave. So when you pair up the 4v2 time consideration with the magnitude of the rally that's occurred, I am more inclined to say, you know what, instead of this being 3-4, I think this was just 1 and 2 of wave C. What that does is that opens up continuation in the dollar to the 1618 C versus A projection. We've already met our C versus A equality. We just smashed through that. This opens up the idea that the dollar does continue to that 1.618 up at 97. That has confluence with the overall 61% retracement of the decline from March into May. Another sign we can watch here is we basically need to pair up this correction. So when we see a correction that we can pair up to the wave 2, we'll then look to the new high or a retest of the third wave high to consider the idea that perhaps this trend has run its course. All right, so that's the dollar, that's gold. Let's quickly take a look at crude oil, then we're going to let you guys get out of here. So here in crude oil, my goodness, we had a very significant move occur. I want you guys to take note of this chart here, and I'm just gonna hide the Elliott Wave labels. Trend line 2013 through 2018. So sourced here, confirmed here. You could have even sourced it here, confirmed it there. So we've got about a decade-long downtrend line in green, this uptrend support shelf in blue. Look what happened at those price levels. This is crude oil, okay? The respect of the technicals, gotta love it. We move up into that green trend line, that downtrend resistance of nearly a decade. We counter trend correct, we move up, we meet resistance again, we set a higher low, and then we break above it. So now we're above this uptrend support shelf that we had broken south of, and we're back above this downtrend resistance line. Look at how we back tested the green trend line. We did so in a three-wave corrective retracement, and we've since moved up. And personally, I see this as another fractal, a smaller fractal of this higher degree pattern. That tells me we could still have further upside to our 90 handle objective in crude oil. For now, I'm still looking at this as wave 4, but again, this is just like the conversation we had in the dollar. Could this be a larger 1-2 instead of 3-4, and we do exceed those upside price objectives? Not out of the question. All right, we're going to go ahead and leave it at that. Hey, if you guys did enjoy the content, we would most certainly appreciate a thumbs up, subscribe with the notifications. Hey, you know what? It's Thanksgiving. We're thankful for our viewers. So I'll tell you what, if you drop a like and subscribe, looking at last week's metrics, about 40% of you who tune in are not subscribed. We're going to take those of you who like and subscribe today, and we're going to go ahead and give away one of our courses next week. I'm going to give away my Elliott Wave Fast Track course. It's a fantastic way to get started with Elliott Wave, and maybe we'll do a membership giveaway later on in the month. All right, if you were interested in Motive Wave, speaking of, we've got the largest discount ever offered thanks to the team at Motive Wave. The Black Friday sale does extend to the trading analysis edition of Motive Wave. You can go to tradinganalysis.com/Motive Wave to get 30% off. This is it's an expensive product. I'm not going to lie. It's not cheap. The regular retail price is $2,295, on sale $1,606.50. It saves me anywhere from 10 to 14 hours a week. And just like working out, Elliott Wave is really about repetitions. The more time you spend manipulating your fib levels, the longer it's going to take you to learn and become more proficient. If you can use automated fib levels and not have to manipulate that, you spend more time working on pattern interpretation and actually understanding the rules, the guidelines, and everything that's going on. So we'll leave it at that. We appreciate you guys taking time out of your morning to join us. Again, happy holidays. Markets are closed tomorrow. We'll be back same time, same place next week with the entire trading analysis team. Sorry I didn't get the opportunity to cover all of the charts. I will put out a public market update tomorrow. If there's anything you guys want to look at, drop it in the comments. I'll take a look at the comments tomorrow before I record. Okay, you guys be safe. We've got 9 minutes to the market open. Futures are continuing to move lower. Thanks again. We love you all, and we'll see you guys same time, same place next week. Enjoy your break. Take care.